Picture this. You and a friend walk into a bank, you have the exact same incomes, and you apply for the exact same loan. But when you walk out, one of you got instantly approved with an amazing rate, and the other, well, they're stuck paying thousands more in interest over the life of that loan. Crazy, right? That massive difference usually boils down to just one wildly misunderstood metric. So, in this explainer, we are going to dive into why chasing a perfectly flawless credit score might actually be giving you a ton of unnecessary stress. We'll pop the hood on how the system actually works and explore why the legendary 800 credit score is kind of just a myth.
Now, we all know the scale, right? That magic number ranging from 300 up to 850. But what is it actually grading? Look, it's not a wealth meter. It doesn't care how much money is sitting in your checking account or how big your salary is. It's literally just a historical reliability tracker. It tells lenders like banks, auto financiers, even your landlord, exactly how you've handled borrowed money in the past. And the basic idea is pretty simple. The higher that number goes, the less risky you look to anyone handing you cash.
Let's bring this into the real world. Meet Jake and Sarah. Jake is sitting right at a 705, and Sarah, she is rocking a massively impressive 820. Now, they both pull in exactly $80,000 a year. They both have super stable jobs, and they both head down to the dealership to buy the exact same $35,000 car. They sit down in those little dealer chairs, get their credit run, and wait for the numbers to come back.
Okay, so who actually walks away with the better deal? Honestly, the waiting part is stressful enough. But common sense just screams that Sarah is going to unlock some kind of super secret VIP discount with that massive 820, right? You'd totally expect her to get an ultra-low interest rate that Jake couldn't even dream of touching.
Well, actually no, and this is where the whole system gets completely fascinating. You see, lenders don't actually reward perfection, they reward low risk. It all comes down to something called credit tiers. Lenders essentially lump borrowers into these broad brackets, and once you cross a certain line, usually right around the mid to high 700s, boom, you're in. You've already qualified for the absolute best rates they offer. So Sarah's 820 is undeniably awesome for sure, but it doesn't give her a magical discount. In the real world, Jake and Sarah are probably getting virtually identical financing offers because they've both proven they're reliably low risk.
Think about it like a final exam in school. If you score a 98% and your buddy gets a completely perfect 100%, guess what? You're both getting an A+. Both of those grades prove to the teacher that you completely mastered the material. The outcome is identical. It's the same with your credit. Once you prove to a bank that you are highly unlikely to miss a payment, grinding for those extra points above the mid-700s, it just becomes significantly less valuable.
Okay, which brings us to a gigantic myth. Like a myth that credit card companies probably love that you believe. You absolutely, positively do not need to carry a balance and pay interest to build an excellent credit profile. I mean it, that is a complete myth. Paying the bank a little bit of interest does literally nothing to boost your reputation. The reality? Lenders just want to see that you pay on time and that you keep your overall balances low. That's the secret sauce.
So what is actually in this elusive formula? When we slice it up, payment history is the undisputed heavyweight champion. It makes up a whopping 35% of your entire calculation. What does that mean for you? It means simply paying your bills on time every single month is hands down the most powerful thing you can do for your financial reputation. Honestly, just one single late payment can tank your score way faster than years of careful building can help it.
Right behind that is credit utilization. Fancy term, but it basically just means how much of your available credit you're actually using. Let's say you have a $10,000 limit. If your balance is $500, you're at 5% utilization. Lenders absolutely love that. But if you max that card out to $9,000, your utilization shoots up to 90%. And here's the kicker. Even if you've never ever missed a payment, being at 90% makes you look incredibly stretched to a lender. The sweet spot? Financial experts recommend keeping it under 30%, but staying under 10% is where the magic really happens. The rest of the puzzle really just comes down to three things: credit age, credit mix, and new credit. Lenders love a long track record of good behavior, so closing your oldest credit card, actually scratch that, don't close it, because doing so can shrink your average credit age and ding your score. Then they want to see you responsibly managing a mix of different loan types. And finally, every time you apply for new credit, you get a hard inquiry. A couple of those are totally fine, but applying for, say, a dozen credit cards in one weekend, yeah, that makes you look a little desperate for cash.
Let's get down to brass tacks and compare a 700 to an 800 in the real world. The truth? The actual financial difference between them is incredibly small. A 700 is going to get you approved for most cars, mortgages, and cards at really solid rates. The 800 mostly just gives you a little extra flexibility and some peace of mind. The real life-changing leap, that happens when you climb from, say, a 620 up into that 700 range. That jump literally saves you tens of thousands of dollars. Going from 700 to 800 is basically just diminishing financial returns.
If you want to build a rock-solid profile naturally, you don't need a cheat code. It's just consistency. Pay every single bill on time without exception. Keep those balances nice and low, and let your accounts naturally age without constantly opening new ones. Keep an eye on your reports to spot any weird errors. And most importantly, be patient. You know, great credit isn't built in a few weeks. It's just the result of quiet, consistent habits over months and years.
So it really all boils down to this simple philosophy. Please don't obsess over hitting that perfectly elusive 850. Just focus on your habits. In the real world, a responsible 760 is often exactly as powerful as an 820 when you're trying to get the things you need. Yes, the number matters, but the daily, weekly, and monthly financial choices behind that number matter a whole lot more. Dial in those healthy habits, and I promise you, the score will naturally take care of itself.
Now that we've completely pulled back the curtain on how lenders actually view your financial report card, I'm curious, what's your target moving forward? Are you aiming for that practical money-saving 700, or are you still kind of tempted to go chase that mythical 800 unicorn? Think about it. How do your daily habits right now align with what you actually want to achieve financially? Food for thought.